figured it would be useful to have the various shifters of these curves described in one video that you can refer to. So again, we're talking about the ISLM analysis when we allow for price changes to be reflected. And we're looking at the simultaneous equilibrium, ultimately, of the goods market, the asset market or money market, and the full employment level of output. So again, there's the IS curve reflects the goods market, and we've got the basic following results. An increase in government spending on goods and services will shift the IS curve to the right. An increase in taxes reduces consumer disposable income. There's less spending that they can do. That will shift IS curve to the left. If we have a decrease in taxes, it would obviously go to the right. An increase in tax on capital, or for that matter on labor. So if you had higher capital gains taxes, you had higher taxes on higher payroll taxes on labor, that would shift the IS curve to the left. If there's increased consumer optimism for whatever reason, you'll tend to see more spending on goods and services today. Shift the IS curve to the left. If there's improved business optimism, it shifts the IS curve to the right. Okay, so we have these things that ultimately start on the goods and services sides of things, and then result in shifts that we'll discuss in more detail later. On the money market, and again, you get the asset market more generally in the background. An increase in the nominal money supply, if there's an increase in money circulation, say because of a central bank action, that is going to by itself, that effect alone is going to shift the LM curve to the right. If you have an increase in the current price level, that will reduce the real money supply, shifting the LM curve to the left. If we have expectations of future inflation, okay, we think inflation is going to increase in the future, that changes my desire to hold money today. An increase in expected future inflation will shift the LM curve to the right. And an increase in current nominal interest rates will shift the LM curve to the left as people are willing to hold less cash if the payments to bonds, for example, rises as a consequence of for example, worries or inflationary expectations. Okay, so there are the basic outcomes for the ISLM curve. Now we finally want to look at what will shift the full employment curve. And basically we have three. A change in the capital stock, a change in the labor force, or productivity shocks, which we talked about in the video about the full employment level of output. So here in one video is all the different effects that you might use to analyze various types of, for example, changes in consumer optimism, how that works through, and we're going to eventually see how this will affect government choices on how to deal with the economic consequences of some of these initial shifts.